Okay, good afternoon to all of you. So today we are going to discuss both the interest income and the dividend income. So we'll start with the interest income. So interest income is the interest is an income from investments such as deposits, government securities, debt instruments and loan given, etc. So that whatever the investment, so we'll receive as a income as a way of interest. So we classify it as a interest income. Then the consideration generally calculated at a rate per percent per annum which the debtor pays for being allowed to use for of this capital. So that for this interest income, so we are having a per annum percentage. Based on that, for use of that capital we have to pay the consideration, so that in the recipient perspective that would be the income, that consideration paid by the company or whatever the individual would be an income to the recipient based on that predetermined rate. That would be the interest income. So how we are going to assess this interest income? So like the other employment income as well, we discussed it should be on accrual basis, so that full amount falling due, whether received or not, any deduction, without any deduction, so we have to take it as a total income, so that whether we have received the total amount or not, we have to consider it as a full income, the whatever the entitled consideration, so we have to take it as the interest income. For certain deposits such as treasury bills and fixed deposits, the total interest is payable on a particular date, that is at the time of maturity. In such a case, the interest income of such investment is taxable at the year of assessment in which it is received. In that case, those things are based on the cash basis. Once we receive the consideration at the maturity on that year of assessment, we have to take it as a interest income. So other things, whatever the consideration we received on our investment, so we have to take the accrual base, that is the falling due amount. So that question number 1, an individual has a deposit for sum of 3 million in a commercial bank on 1st August 2015 at annual interest rate of 8%. Determine his interest income for year of assessment 2015 and 16. So that he has the investment 3 million, he has deposit on commercial bank on 1st August 2015 at annual rate of 8%. So that what would be the interest income for the year of assessment 2015 and 16? Okay, so application would be, so interest income, total deposited amount would be 3 million. So interest rate would be 8%, and we have done the investment on 1st August 2015. We are considering for the year of assessment 2015 and 16. So that only 8 months period we received the interest. So that 160,000 would be the total interest income. Then question number 2, an individual has deposited a sum of 930,000 in the treasury bills on 1st May 2015 for a period of 1 year. He has received at the maturity value of 1 million on 30th April 2016. Determine the interest income for the year of assessment 2015 and 16. In this case, he has deposited only 930, but at the maturity he will receive 1 million. But he has made the investment on 1st May 2015. The maturity date would be 30th April 2016. So you have to determine the interest income for the year of assessment 2015 and 16, because we are calculating the interest income for the 15 and 16. So what would be the interest income? So that interest income for the year of assessment 2015 and 16 is 0, because even though he has paid the invest 930,000 in within that year of assessment, but he received the interest, that is the income on the maturity, that is the maturity date would be 30th April 2016. It is out of the year of assessment, because the year of assessment will be ended up with 31st March 2016. So that for this year of assessment 2015 and 16, he need not to pay on the interest income on that treasury bill investment. So for the year of assessment 16 and 17, he need to pay the interest. He need to consider it as a interest income, because the maturity date would be in that year of assessment, that is 16 and 17. So that in the 16 and 17, the interest income would be 1 million minus 930,000. That would be the interest income received in that particular year of assessment. But at the moment, for the year of assessment 15 and 16, he does not have any interest income. Okay, that is on the, this example is relating to the cash basis. The previous one is on the accrual basis. The other thing is interest from abroad. Where interest is received from abroad, any tax payable abroad in respect of such income should be deducted and net amount shown as interest income. If you have the foreign investments, so in that case, so you are receiving the interest income. So when you are receiving the interest income, if we have to pay the any taxes according to these foreign countries rules and regulations, so you have to take the net amount as the interest income received. The other one is, in the case of money lending, the interest is considered as a business income. So that would be the, as a business, if you are going to do the money lending activities, not as an individual investor, but as a business, if you are doing this money lending business, so in that case, the interest income is not the source where we are going to discuss today, that is interest income. That if we receive that interest income, you should have to classify it as a business income, because it is the income which we are doing that money lending business, that would be the income. So that in that case, this money lending business, if you have received the interest income, you should have to classify it as a business income. The business income, the next topic would be the profit from trade, business, profession or vocation. So you are going to study in detail. So that in the money lending business, so you have to consider it as a business income, and accessible under section 3A, all outgoing expenses are deductible, and the prohibition of deductions from interest or sources will not apply. Normally in this source, interest income source is a separate source. So in that case, when you identify the interest income, you are not allowed to deduct any of the expenses other than the income received from the abroad. But these abroad income, so you are allowed to deduct only the tax payable under these countries, other than no any other expenses. So if you are doing the money lending business, so it is not pertaining to the interest income, but it is pertaining to the business income. In that case, when you are calculating that business income, you are allowed to deduct expenses and the outgoings according to the section 25 and the 26. You will be discussing it later. So in that case, you can deduct those expenses, and finally you can identify what would be the money lending business total income. Okay, so that is about the interest income. So that anyhow, so when you are doing the investment, the consideration would be the income. So the other thing is, when you are receiving that interest, it will always subject to the withholding tax under the Inland Revenue Department of Inland Revenue, so that the interest payment subject to the withholding tax are, we are going to classify it as a 3 different areas. Okay, so when you are receiving that interest, most probably, in the most frequently, you are receiving the net amounts once we the institution and the company, they are going to deduct that withholding amount when you are when they are paying that interest income to the respective deposit holder or the investor, so that you are, as a recipient perspective, you are receiving only the net amount. So that today we are going to discuss, so what would be the withholding tax on this payment of interest. The 3 different areas are interest on deposits with banks or financial institutions, interest on government securities, interest on corporate debt securities. Those are the 3 main areas where the Inland Revenue Department acts focus on this deduction on the withholding tax. Okay. This is the first category, that is interest on deposits with banks and financial institutions. So in that case, all the banks and financial institutions are required to deduct a withholding tax at a specified rate from the interest payable on the deposits of income tax payers. That means when you are receiving the interest income, that bank or the financial institution, they are going to deduct that withholding tax portion from our interest income. So in previously they have identified different assessable income categories, assessable income levels, but with effect from 1st April 2015, they have identified these fixed rate of withholding tax rates. So for the individuals like us, so that if we have the deposits with banks or the financial institution, withholding tax would be 2.5%. That means they are going to retain that 2.5% of our gross investment, gross interest income. Then they are going to remit it to the Inland Revenue Department. The balance 97.5%, those banks will be paid us to as the interest income. For the charitable institutions, 2.5%, partnerships 2.5%, body of persons 8%, and for the companies 10%. These are the withholding tax rates which will be applicable with effect from 1st April 2015. But earlier they have identified whether their accessible income is there. In that case, for your information, we have to provide the declaration on normally what is your average accessible income for that particular year of assessment. So based on that, if the accessible income is less than 500,000, the banks or the financial institutions, they are not going to deduct any of the withholding tax, it is 0. But in between 5 lakhs to 1.5, so they are going to deduct 2.5%. If it is the assessable income is greater than 1.5 million, they are going to deduct maximum 8%. So if that means when we are making the deposit, so in that time itself you have to provide that declaration. If the deposit holder is not in a position to provide that declaration, straight away they are going to deduct 8%. But now this practice is not, this would be the applicable rates. The other thing is when an individual or charitable institution is paid interest for a month which is less than 5,000 for one saving account or more than one saving account, no deduction is required to be made by the bank or the financial institution since such part is exempted from tax. For the this would be applicable only for the individuals and the charitable institutions. If you are having the savings account or more than in previously they have exempted only for one savings account, but now if you have more than one savings account even but the monthly interest is less than 500,000, so these banks and the financial institutions, they will not deduct any withholding tax because that interest income would be considered as a exempted income. So this is applicable only for the interest savings accounts. Okay, then so for our income, the banks or the financial institutions, they need to deduct this withholding tax, and as well as they have to issue the withholding tax certificates for the deposit holders. So any bank or financial institution which deducts withholding tax from interest is required to issue a certificate of tax reduction to the deposit holders, setting out following particulars, so that they have to mention the what would be the gross interest income, the rate and the amount they have deducted, and the net amount they have actually paid to the deposit holder, and the period in which that interest is related to. That normally within that 12 months period, or what would be the period they are going to consider for this interest income. So these information should be included in the certificate of tax deduction issued by these banks or the financial institutions. Okay, this is regarding the investments and the deposits held in the banks or the financial institutions. The second one would be the interest on government securities. So where any bank or financial institutions deduct any government securities such as treasury bills and treasury bonds at the price less than the face value, the bank or financial institution shall deduct at 10% on the excess of the face value of such price. Okay, the normal thing is the government securities these government securities trading activities in two market, the primary markets and the secondary market. So central bank and the government and the primary dealers, they are having the transaction in the primary market, and then primary market dealers and the individuals they can purchase these treasury bills and treasury bonds in the secondary market. So in this primary market activities, when you are issuing the treasury bills and the treasury bonds, we are going to deduct this withholding tax, so excess over the face value, so that we are going to pay only the net amount. So in that case, if you are a bank or the financial institution, we are purchasing that one, so you are deducting that withholding tax, but such deduction would be made at the time of issue such security at the primary market stage only and no further. That means in the secondary market transactions, the withholding tax will not be applied because it has already deducted when it comes to the primary market transaction. So you have to key in on that one, whether the transaction is happen in the primary market or a secondary market. So if you are going to purchase the treasury bills or the treasury bonds like us, so it is definitely in the secondary market. So in that case, there is no withholding tax. So what we have received, it should be considered it as a gross income. That would be in nutshell. So that as an individual, if we receive that interest on this treasury bill, so it would be the gross amount, not the net amount. So you have to consider on that. Then the third one is interest on corporate debt securities. That means debentures and the preference shares. Normally we consider it as a corporate debt securities. Any company which issues corporate debt security has to deduct from interest on such security at a tax of 10%. So when you issue in the corporate debts, we are fixed this much would be the interest income. So based on that, the companies will pay the interest income to the debenture holders or the corporate debt security holders. So when the companies they are paying the interest, they will deduct the withholding tax at a rate of 10%. So with effect from 1st April 2011, withholding tax is to be deducted at the point of issue. When you are issuing the things, we have to deduct this withholding tax. However, where any other corporate debt security issues with floating rates of interest payable for reviewing periods, tax has to be deducted at the time of beginning of each such reviewing period of interest. If these debt securities are renewing period, so in that case, each reviewing period we have to deduct these withholding tax rates. Okay, so let's come to the next question. An individual has received the sum of 85,500 from a company in respect of investment made in debentures. Determine the interest income of this person. So he has received 85,500 from a company by investing in a debentures. So this you have to first determine, because you have to determine the interest income. So interest income you have to consider. For the tax purpose, you have to take the gross amount. That is a consideration. That's why we are studying this withholding taxes as well. When you are calculating the taxable income, so you have to take the gross income. So in this case, the individual, he has received 85,500 from the company for the investment on the debentures. So you have to first decide whether this is a gross amount or the net amount. According to these instructions, what would be whether it would be the gross amount or a net amount? So it should be the net amount, because this is relating to the corporate debt securities. So that means when we individual receive the income, definitely company should have to deduct the interest withholding tax on that interest. That means the amount he has received should be the net amount. So that, but our concern is not to take the net amount but to take the gross amount. So you have to gross it up. So then you have to decide what would be the applicable withholding tax rate. In this case, you haven't mentioned any of the withholding tax rate. So you have to decide what would be the applicable withholding tax rate. So in the previous section we mentioned that for the investment held in the corporate debt securities, the applicable rate, the fixed rate would be 10%. So that you have to take the 10% as a withholding tax rate. That means the 10% means this 85,500 would be the 90%. Then you have to take it the total 100%. So that it should be 95,000. So that for that individual, the income source under the interest income would be not 85,500. You have to take the 95,000. That would be the interest income. So next one would be treatment of withholding tax as final tax, so that the amount of withholding tax deducted on such interest is treated as a final tax to the individual investors. That means, this means there is no involvement in further taxation on such income. Normally, for the individuals, that the withholding tax already deducted on the interest would be the final tax. If withholding tax is not deducted, such interest will form part of assessable income and normal progressive tax rate will be applied. So, when you are receiving the interest income, if the companies does not deduct any interest income, any withholding taxes, so that it will not be exempted, so that you have to add to the whatever the interest income is there. Normal the income tax rates, I have mentioned that 4 to 20% income tax rates are there. So these rates will be applied for this interest income, but it will apply if the withholding tax would be not deducted at the time of when we are receiving that interest income. But if you are, when you are receiving the interest income, or you have already paid that withholding tax, so that would be the final tax for that particular income. So for that income there will not be any further taxation on such income. So when you are calculating your taxable income, you will be studying there when you are before calculating the taxable income, there is a part called assessable income. So when you are calculating the assessable income, there is a part which will relate to income not form part of assessable income. So the income not form part of assessable income means the where the income we have paid the withholding tax when you are receiving that income. So these almost all the income sources, total income you have to identify out of these total income, then you have to deduct that the income where we have already paid the withholding taxes. So that means that we are going to eliminate that from the total income, means we are not going to pay the another any whatever the income tax on those income. That's why it become the final tax. The next one would be exemptions from interest income, because each and every source, even for the employment income, property income, we discuss the exemptions. So for this one as well, there will be some exemptions. Interest on foreign currency banking units. So interest received on that, we are not liable to pay any taxes on this foreign currency banking unit interest income. Interest on foreign currency accounts, interest accruing any person in money lays on his credit foreign currency opened with the approval of the central bank, so that these accounts as well, the interest income will be exempted from the income tax. Then interest to senior citizens, so that interest income in a year of assessment to any individual who is a citizen of Sri Lanka and resident in Sri Lanka. You have to make sure that those things, he should be a citizen and the resident, two concepts, and he is more than 59 years old. The first day of that year of assessment from any deposit maintained any bank or any registered society is exempted from income tax. That means in the previous practice is that year of assessment interest income is greater than 500,000, but now it is that threshold has been abolished, so that whatever the interest income he has received during that year of assessment, the previous rule would be it should be only the state bank, but now they have mentioned that any bank or any registered society he has made any deposits, the interest income received should be exempted as a senior citizen. Senior citizens means he should be a citizen as should be a resident in Sri Lanka according to the tax rules and regulations, and he should be more than 59 years old. So that for this income would be exempted from the interest income. The other thing is interest from investment made outside Sri Lanka. interest from any investment made outside Sri Lanka to any person resident in Sri Lanka where such interest is remitted to Sri Lanka through a bank. So in that case, if you remit that interest income through a bank, so that this interest income will be exempted from the income tax. Then, but make sure that that person should be a resident person. Then interest less than 5,000 per month. So with effect from 1st April 2015, interest accruing or arising to any individual or a charitable institution has been made as exempt if such interest is less than 5,000 per month from one or more than savings account. So that would be the exemptions. Already we have discussed it previously, but it would be exempted. That's why we are not going to consider as a taxable one. So these things would be exempted. In your questions as well, if you have received this kind of interest income which are relating to these exemptions criteria, so you have to carefully read whether this is exempted one or not. If it is exempted one, so you have to clearly put that it is an exempted due to this matter, so you are not liable to pay the income tax. So the amount would be 0 for the total income calculation. The other things you have to separately identify what would be the total interest income. Then the special case would be the irrecoverable interest. That means where interest on a loan has not been received and is like to be irrecoverable, the taxpayer may include such interest from his income, exclude such interest from his income. In such a case, interest will not be assessed as accrued. So that if you have an assurance that those things are irrecoverable, so you can exclude that interest income, even though we have to calculate the interest income on the accrual basis, but whatever the period, it may be 2 months or 3 months time period interest income, we are assures that it will not be recovered, so you can take only the balance month's interest income. Where such exclude interest has subsequently been received, which will be subject to the assessment. That means like in the bad debtors as well. So now this year of assessment you mentioned that it is irrecoverable, but in the subsequent year of assessment those interest may be received in the future period. So once we receive that interest income on which year we have received, you have to pay income tax. That means you have to take it as a income or the interest income in that particular year of assessment. Okay, that means in the irrecoverable interest in this year of assessment, sometime you may be identify 3 months interest income would be recoverable, so you are going to take only the balance 9 months things, but another 2 year of assessment later you will be receiving this 3 months interest income. That means on that year of assessment you have to take that interest income as the in that particular year of assessment's interest income. Shall we develop the answer for this question number 4? Mr. Pereira is an income taxpayer and his assessable income for year of assessment 2015 and 16 amount to approximately 5 million. During the year of assessment, he has received the following interest income. From a fixed deposit made in National Savings Banks amount to 45,000. These are the interest income that he has received. A fixed savings account in National Bank amounts to 83,000. From Treasury bills invested in NSB amount to 250,000. From resident foreign currency account with People's Bank amounts to $1,000. From debentures invested in ABC Limited amount to 27,000. So determine the interest income of Mr. Pereira for year of assessment 2015 and 16. So just having 5 minutes, shall we calculate the answer? You can provide the answer online, students. Okay. Uh, First one would be from a fixed deposit made in National Savings Bank. So this is relating to deposits under section 133, that is deposits held in banks or the financial institutions. So in that case, the amount he has received would be 45,000. The problem is that we have to decide whether that interest income is a net interest income or the gross interest income. So in this case, whether that 45,000 is a net or gross. So this one exactly, it should be the net amount, because the banks or the financial institutions, when they are paying the interest income, so they are going to deduct the withholding tax from that deposit holders. So the next problem is that if it is net amount, then you have to gross it up. So in order to gross it up, you have to identify what would be the applicable withholding tax rates. So for the individuals, deposits held in banks or the financial institutions, the withholding tax rate would be 2.5%. That means they have received 45,000 as a 97.5. Then we have to calculate what would be the total gross interest. 45,000 divided by 97.5 into 100, that means 46,154. Then interest on savings accounts. So again, it is deposits held in banks or the financial institutions. Here I have mentioned that if we have the savings accounts as individuals or the charitable institution, because that interest is relating to, according to this question, is an individual. So you have to identify that whether that interest is less than 5,000. So in that case, you have to identify what would be the interest income, but in this case they haven't mentioned any of the information. So that means again 83,000 would be subject to the withholding tax of 2.5%. So that 83,000 divided by 97.5 into 100. So that 85,128 would be the gross interest on these savings accounts. The third one would be interest from the treasury base invested in NSB amount to 250,000. So in the case of treasury base, I have mentioned that two markets are there. So if it is in the primary market, that means withholding tax would be deducted and the net amount would be the income received. But in the secondary market, no withholding tax would be there. So that in that case, the amount received as a interest income, that would be the gross income. So in this case, that individual, he has purchased the treasury bills in the NSB. That means that treasury bills is transacted in primary market or secondary market. So this is the transaction which has placed in the secondary market. That means there is no withholding tax deductions in this 250,000. So that total 250,000 would be considered as a gross interest income. So it is taxable. Then next one would be from resident foreign currency accounts with People's Bank amount to USD 1,000. So $1 would be 130,000. So that how much would be the interest income? 1,000 into 130. But interest in the interest from foreign currency accounts would be exempted. We are not liable to pay the income tax on these resident foreign currency account, so that it would be exempted. The last one would be from debentures invested in ABC Limited amounts to 27,000. The same Mr. Pereira purchased the debentures from the ABC Limited. In that year of assessment, he has received the 27,000 interest income on these debentures. So that means these debentures, this 27,000 would be again net income or gross income. You have to decide whether it is a gross income or net income. If it is a gross income, just you can put it as a 27,000. If it is not, you have to convert it to the gross income, then add it to the interest income. So in this case, the debentures, they are issued by the companies. When they are issuing, when you are paying the interest, they are going to deduct withholding taxes at a rate of 10%. That means 27,000 would be the 90%. Then you have to take the gross amount, that is total 30,000. So that in a total 411,282 will be the total taxable interest income of Mr. Pereira. So this is a one separate source of income. At the top, if he is an employee, employment income is there according to the calculations made by our in the second session. The next one, if we have the properties, so that total property income, it may be net annual value, rent income, occupiers income. So you have to take the total profit from employment, income from property. Third one, if you have the interest or the investments, so that you have to take each and every interest income, you have to identify whether it is taxable or not. If it is exempted, you have to just ignore that one. If it is taxable, you have to decide whether we have received the net amount or the gross amount, because for the tax purpose you have to take the gross amount. So if it is net amount, you have to convert it to the gross amount and then finally take the total interest income. So that would be the interest income. Is a small part. So if we have clarifications or queries, you can raise. If not, we can go for the next topic. Okay, today as planned, next one would be the dividend income. Okay. The dividend income is an income to a shareholder through distribution of profit of a company. We have purchased the shares from the company, so the income is going to classify it as a dividend income for that shareholder. The dividend is another type of investment income of an individual who received such income by investing in shares. The interest income will be received either deposits or purchasing the debt capital instruments of the company, but the dividend will receive if you are purchasing the equity capital of the company, so that he will become a shareholder and he will receive the share of profit from the company as a way of dividend income. But we focusing on, for the tax purpose, how we are going to identify this as a separate source of income. So dividend is a distribution of profit by a company. That would be the in nutshell, that would be the meaning. It's just a distribution of profit by a company to its shareholders. The law recognized following forms of distributions in the definition according to the Inland Revenue Department Act. These different types of distributions are identified as dividends. Money owed in an order to pay money. So if you are going to pay in terms of money or in order to pay money, so it is classified as a distribution of a profit or a dividend. Dividend paid in form of money and checks are frequently occurring in most of the circumstances. That would be the most frequent dividend mode. Then some companies, they distribute their dividends as a way of shares in any other company. A company can distribute dividend in a form of shares in any other company. The value of shares received by a shareholder is dividend income for the purpose of income tax. The value of shares received by the shareholder would be that dividend income. In that case, we are not receiving a cash benefit, but instead of that, he has received the shares. The third one would be the debentures in that company or any other company. The company may also distribute dividend in the form of debentures. In that case also, value of the debentures received is a dividend for tax purpose. In that case, the value of debentures received would be the debenture, the dividend for the tax purpose, not the interest one. The value of the total debentures we received as a dividend should have to assess as the dividend received. The next one would be where a company buybacks shares from its shareholders. So the excess, if any, paid to shareholders over the market price of such price as at the date on which they are shareholders of the company at a meeting approved, such buyback is considered as a dividend income from 1st April 2013. That means we have issued shares to the shareholders, then company is going to buy back these shares from the shareholders. So in that case, if the company is going to pay the price for that shares over and above the market price at that prevailing conditions, that excess amount we are going to again consider as a dividend income with effect from 1st April 2013. The next one would be the amount of capital returned or distributed to extent of period up to value of the bonus shares within 6 years from the date of issuing of such bonus shares by capitalization of profits. That means normally bonus shares we are not going to consider it as a dividend, but if you are going to distribute or the return capital to the shareholders out of our retaining profits, so that if that profits are within the 6 years of capitalization, so that would be considered as a dividend for that issuing of the bonus shares. Other than that, the bonus shares are not considered as the dividend income. The amount of capital returned or distributed to the extent up to value of any bonus shares within 6 years from the date of issuing such bonus shares by capitalization of profit. That means within that issuing, the bonus shares are normally we are issuing based on the profit of the company. So that these profits are within the 6 years of issuing that bonus shares, so that we can consider it as a dividend income. Question number 1. State whether the following can constitute as a dividend income to the shareholder for the year of assessment 2015 and 16. So you have to decide whether it is a dividend income or not. First one is issue of shares to the employee of a company at the price less than the market price. Issue of the free debentures to the shareholders by issuing the company's profit. Repayment of the consideration in respect of shares by back to amount of the market price of the shares. Repayment of the consideration in respect of shares by back to amount higher than the market price of the shares. So you have to decide whether these four are pertaining to the dividend income, because I have mentioned that it may be money or in order to pay money in terms of the shares or in terms of the what debentures, or even the if the company purchase the shares again from the shareholders, again there is a distribution of the dividend. So you have to think whether these are relating to the dividend income or not. Just having 5 minutes, can you identify? Okay, shall we develop the answers? Issue of shares to the employees of a company at a price less than the market price. Now we are going to issue the shares to the employees of the company, the price less than the market price. So is it a dividend? So it is not a dividend because it is shares issued to the employees. So it is, we cannot consider it as a dividend because it is not issued to the shareholders as a distribution of the profit, but it is more or less, it is under the share ownership plans we are going to issue it to the employees, so it is not a dividend income. Then issue of the free debentures to the shareholders. So in that case we are going to issue the debentures so that this can be considered as a dividend income, since there is a distribution of profits to the shareholders as a result of this, because they are going to issue the debentures free of charge by using the company profit. That means there is a purpose of distributing profits to the debenture shareholders. So without paying the money, so they are going to issue the debentures at a free of charge. The Third one would be repayment of consideration in respect of shares buyback to the amount the market price of the shares. That means companies, they are going to buy back the shares from the shareholders. So in that case, they are going to pay the amount of a share equal to the market price. So in that case, that payment is considered, whether we can consider it as a dividend, prepayment consideration. In that case, company is going to pay it to the shareholders up to the market price only. So as per the discussion, this cannot be considered as a dividend income because that redemption is made at the market price. So up to the extent the market price, if you are going to pay the repayment consideration, it is not considered as a dividend income. The last one is repayment of the consideration in respect of shares buyback to the amount higher than the market price of the shares, so that repayment consideration is paid more than the market price of the shares to that shareholders. So that repayment consideration is considered as a dividend income because that redemption is made at the price higher than the market price. So in that case, there is a distribution of profits to the benefit to the shareholder. So in that case, that repayment consideration you are going to consider as a dividend income. Again, we have to deduct the tax on dividend. When a resident company distributes dividends to its shareholders, it is required to deduct withholding tax on dividend at the time of distribution and remit such amount to the Commissioner General. The rate of withholding tax for the dividend distributed is at 10%. So that the fixed rate would be 10%. That means when we are, as a shareholder, if you are received the dividend, that means you receive the net dividend. But in the tax perspective, our concern is not to take the net dividend, but you have to gross it up. So then according to that, you have to recalculate the dividend income. The circumstances in which withholding tax is deductible. Okay, so that company is entitled to deduct withholding tax on the distribution of dividend under the following circumstances. So that distribution in the form of money or in order to pay money. That means if we are receiving the dividend as a form of money or in the form of checks or any other payment mode, so we have to pay the withholding tax. But I have mentioned that even the distribution of profit will be as a mode of by issuing shares or the debentures. Those are subject to the income tax, but it is not subject to the withholding tax. That means when you are receiving the shares as a dividend which we invested in that particular company, so amount of shares we are going to consider it as a dividend income, but it is not subject to the withholding tax. That means the amount we receive, the total share amount, is a gross income. So the gross dividend or the debentures, similar, the amount we received as a debenture value is a gross dividend, not the net, because if we receive the dividend in the form of shares or debentures, companies are not entitled to deduct withholding taxes. Then distribution out of profit, whether such profit is taxable or not. The requirement of withholding tax is applicable where the company distributes the dividend out of profits, whether such profits are taxable or not. In other words, when dividend is distributed even out of exempted profit, such distribution is subject to the withholding tax. So that if the companies distributed the dividend out of their profit, taxable or exempted profit, they have to deduct the withholding tax. There is no any exemptions on that one. Dividend not subject to withholding tax. The distribution of following dividends to an individual shareholder is not subject to the withholding tax. That means dividend out of dividend received. So in that case you received the dividend out of dividend received by another company of that company. So in that case, companies are not liable to deduct further withholding tax when they are paying dividend to the individual shareholder. The next one is distribution of dividend exempted from tax. Any dividend which is exempted from income tax under section 10 is not subject to the deduction of tax. So these things are not for the individuals. Withholding tax for these dividends income, companies will not deduct the withholding taxes. Question number 2. Specify whether company shall deduct withholding tax in respect of a following dividends paid to an individual during the year of assessment 2015 and 16. A private company paid dividend out of trading profit. A private company paid dividend out of dividend received. A quoted company paid dividend out of trading profit. A company paid dividend out of exempted profit. So you have to specify whether we have to deduct the withholding tax paid to the individuals or not. Have we finally, shall we decided the answer? Okay. A private company has paid the dividend out of the trading profit. So you have to decide whether it is subject to the deduction of withholding tax or not. So the profit out of whether it is taxable profit or not, we have to deduct the withholding tax if it is out of the trading profit. So withholding tax on dividend in the year of assessment 2015 and 16. So we have to deduct the withholding tax. Next one would be a private company paid the dividend out of dividend received. So they have paid the dividend to the individuals, but they have used when you are paying the dividend, the dividend received by that company from another company, they have used that dividend to distribute the dividend to that particular individual. So in that case, when you are receiving the company, the company has paid that withholding tax, so that when the company paying that individuals to that dividend, company is not entitled to deduct the withholding tax, because under the deductions not subject to withholding tax, what we have discussed earlier, distribution out of dividend received will not subject to the withholding tax. So that withholding tax is not deductible on the dividend since the dividend has paid out of the dividend received. Then a quoted company paid dividend out of trading profit, so that whether it is a private company or a quoted public company, they have paid the dividend out of trading profit, they need to deduct the withholding tax. Next one, the company paid dividend out of exempted profit. So in that case, they have paid the dividend out of exempted profit. So whether it is taxable or exempted, we have to deduct the dividend, but the company distribute the dividend exempted from the income tax, so that under section 10 we are going to discuss it later. So in that case, companies are not entitled to deduct the withholding tax, but the company distribute the dividend out of the exempted profit, even though they have to pay the deduction, we have to make the withholding tax deductions, but the company distribute the dividend out of the exempted dividends, so that those are not subject to the withholding tax deductions. So then our focus is to computation of the dividend income. So after the break we'll start that one. Okay, we'll start the session. Up to now we discuss what do you mean by a dividend, how we can issue the dividends to the shareholders, then what would be the withholding tax on the dividend income. So on which situations dividend withholding tax will not be deducted. Then we focusing on the computation of the dividend income. So dividend income is assessable to a shareholder in the year of assessment in which the dividend is distributed to him by the company. So that based on the distribution of the dividend by the company in that year of assessment, the shareholder should have to take that dividend income to his assessable income. And then how we are going to distribute how we are going to identify the total gross dividend. So I have mentioned that most of the time you are receiving the net dividend, then you have to add the withholding tax percentage. The percentage is fixed 10% if it is deducted. If not, you will directly receive the gross dividend. So you can use the amount you have received as a gross dividend if the withholding tax is not deducted. If so deducted, you have to convert into the gross income, gross dividend, and then take the total gross dividend. Then there is no expense deductible in the computation of the dividend income. So when you are calculating your gross income, gross dividend income, you are not allowed to deduct any of the expenses. So whatever you have received, the entitled amount, you have to take it as a total dividend income. Where any person other than the company who is not carrying on a business receive the dividend and tax at 10% has to be deducted. The tax deductible is considered as a final tax. For the individuals, if you have received the dividend income as one source, you have purchased the income, purchased the shares from the company. So in that case, when you are receiving the dividend income, you have already paid the withholding tax. So that would be the final tax. No further tax will be charged on for the companies, for the individuals. And where a company declares dividend out of dividend received by another company, the shareholder will not taxable on such dividend because it is withholding. Tax will not be deducted when you are receiving as an individual shareholder. So these are the things you have to be considered when you are computing the dividend income. When it comes to the let's say for the dividend distributed not in the form of money or in order to pay money, or let's assume that it is in the form of shares or the debentures, so that I have mentioned that withholding tax will not be deducted when you are receiving that dividend. So that the amount you have received as a value of share or the value of debentures, you have to take it as a total gross income received. But in the company perspective, company should have to, anyway they have to pay the dividend tax on the dividend distribution. You are studying in the company taxation. So in that case, companies are going to pay that 10% tax on their trading profit, so that the individual shareholders, they can take they have, because when you are receiving their dividend in the form of shares or debentures, they are not entitled to deduct the withholding tax. So that means they can take it as their assessable income. But in this case, if you are receiving the dividend subject to the withholding tax, in that case, shareholder is not taken that income as the assessable income. That's why I have mentioned here. So because I have mentioned that when you are identifying the assessable income, you have to eliminate the income where we have paid the income tax or withholding tax in upfront and when you are receiving. So these income, because those things are not further tax in that. That's why I have mentioned that it is in the shareholders perspective that dividend which have received out of whatever the dividend withholding tax deducted things will not be in their assessable income. So but the same individual, he has received the dividend as a way of shares or the debentures. In that case, when you are receiving that debentures or the shares as a dividend, the shareholders did not paid any withholding tax because he has received the gross amount. So in that case, he should have to incorporate that in their assessable income because it is not subject to the withholding tax. But for that purpose, company is going to pay that income tax out of their trading profit, so that shareholder can claim it as a tax credit when they are paying the income tax. So those things you will be learn in the company taxation, but for the moment I will again incorporate those things for this PowerPoint presentations and upload it, because I am referring here only in terms of paying the dividends in money or in order to pay money and the business profit. But if you have receiving the dividend out of shares or other debentures, these calculations will be somewhat different, because in that case you are receiving the gross dividend as it is. So you have to keeping these things as well in your mind. Then the exemptions. I have mentioned that in section 10, in previous situations, the dividend which are not subject to the withholding tax. So these are the exemptions from this dividend income. So from BOI company which entered into an agreement prior to 1st November 2002. So dividend paid any shareholder by said BOI company is exempted from income tax under the following circumstances. So that if the BOI company has a agreement prior to 2002, entered into the agreement with the 2002, so that those companies paid the dividend to their shareholders are not subject to the income tax. So these are the circumstances. Dividend should be distributed out of profits and income exempt from income tax in terms of BOI agreement, so that they are going to issue the dividend out of their profit. Though those profits and income are exempted according to the from the income tax according to the BOI agreement, so that these dividends received by that particular shareholder would be exempted. Such dividends should have been distributed within the prescribed period, that is during the exemption period or within 1 year thereafter, so that it will be exempted. So these consider as a dividend, exempted dividend. Then foreign dividends. Dividends paid after 1st April 2008 by a company non-resident in Sri Lanka to a resident shareholder. Such dividend is remitted to Sri Lanka through a bank. That means company non-resident in Sri Lanka, non-resident companies are going to, because in the first day we have decided how we are going to decide the resident and the non-resident for the individuals as well as the companies. So in that case, the company is a non-resident company, but the company is going to pay these dividends to the resident shareholder, individual, or it may be a company again. It should be paid after 1st April 2008, and those dividends should be remitted through a bank to the Sri Lanka. If so, this dividend will be exempted from income tax. The other one is the dividend received from any unit trust or mutual funds. If the dividend has paid to a shareholder of unit trust or mutual funds, those are not subject to the taxation. Okay, so these are the things you have to be keep in your mind. So is there any exempted dividend? So you are not liable to pay any taxes. So but if it is dividend is distributed, they are exempted or taxable income, they have to pay the taxes. So here as in interest income as well, they have to consider the company should have to issue the particulars of this dividend. So these are the particulars they have to be incorporated in these particulars of these dividends. The gross amount which after deduction tax corresponds to the net amount actually paid, tax deducted at source, net dividend paid, the composition of gross dividend, that means how that gross dividend has been declared out of dividend received, or whether it has been issued out of exempted income or any other profits and income. They have to clearly mention the composite. That's how we can identify whether that income dividend part is subject to the withholding tax or not. Otherwise the recipient will not known about whether it is taxable or not. So that when you are issuing the dividends, they have in the particulars, they have to clearly mention these dividends. The composition would be, gross dividend composition would be these things areas, and the net tax source and the net dividend paid. All the particulars we have to incorporate in the dividend warrant. Then look at this question. An individual has received the following dividend for the year of assessment 2015 and 16. So you have received 4 dividend income. sources. So you have to determine final taxable dividend income. From B Limited, out of exempt profit of 120,000, B Limited is a BOI company, entered into an agreement with BOI in April 2002 with tax exempted period of 13 years. Then from D Limited, out of exempted profit in 170,000, D Limited is also a BOI company, entered into an agreement in August 2007 with 8 years tax exemption period. From Unit Trust, 130,000. From a company resident in Singapore, US dollars 2,000. The entire dividend has been remitted to Sri Lanka in foreign currency through a bank. So you have to decide whether it is taxable dividend or exempted dividend. So just having 5 minutes, can you determine? Okay, let's look at the answers. So first one would be, now we are focusing on the 2015 and 16. From B Limited, out of the exempted profit, 120,000, and B Limited is a BOI company, entered to an agreement with BOI in April 2002 with income tax exempted period of 13 years. That means under the exemptions we have discussed, BOI companies, prior to, we have to enter into the in order to claim that exemptions, those agreements should be prior to 2002 November 6, so that it has mentioned that if it is in between that period, such dividends should be exempted during the exemption period or within 1 year thereafter. So that that means according to this question, they have entered into 13 years BOI period before November 2002, that is April 2002. That means they can claim that exemptions, so that 2000 they can go up to 2015 and 16 and 1 year thereafter. So that in that context, this dividend received by this B, from this B limited, 120,000 will be exempted from income tax. So you need not to pay income tax on this 120,000 because that BOI agreement is entered into before 2002 November. So they can claim that period and 1 year thereafter. So that altogether 14 years they can claim. And we are in now 15 and 16, so it will be exempted. And next one would be from B limited. So this would be the answer. So it is exempted. And B limited, out of exempted profit 170,000, and D limited is also a BOI company which entered into an agreement in 1st August 2007 with 8 years tax exemption period. So in that case again it is a BOI entered agreement company. Again they have issued that dividends based on their exempted profit. So in that context, whether that dividend is exempted or not, that would be the question. So in order to claim that exemption, so BOI agreement should be entered prior to November 2002. If so, they can claim that dividend exemptions, but in this case, they have entered into the agreement after 2002, that is August 2007. That means they have to pay income tax on this dividend. So that in that case they have to they are going to deduct 10% of the what they are dividend going to pay. That means we have received the net amount 170,000, so what we have to gross it up. That means total dividend received. The gross dividend received, even though it is BOI company, it is not subject to the exemptions. They have to deduct the withholding taxes. So 188,880 would be the gross dividend paid. Then from unit trust, straight away if you have received the dividend from unit trust or mutual fund, it is exempted. So we need not to pay any income tax on that one. And the last one would be from a company resident in Singapore. That means a non-resident company in Sri Lanka. And out of it is 2,000 US dollars. The entire dividend has been remitted to Sri Lanka in foreign currency through a bank. In that case, we can claim the exemption because dividend as in the under section 10 as the foreign dividends. So the dividend has been paid after 1st April 2002 because they have paid in this year of assessment by a non-resident company, but it is resident in Singapore. And Sri Lanka, we have to assume that that individual is a resident individual, so that total they have to remit that dividend to the Sri Lanka through a bank. So all the criteria are satisfied, so that for this foreign dividends 2,000 US dollars will be exempted from the tax. So that total dividend, even though 4 sources are there, you are liable to pay the income tax on this 188,880 only. So that when you are receiving the dividend income, different sources will be there, different criteria would be there, but you have to carefully analyze whether it is taxable or not. If it is taxable, you have to gross it up. If not, you have to take as it is, and especially in the form of, if you have received in the form of shares or the debentures, so you have received the gross amount, so need not to convert into the gross amount. So you have to put it as it is. If it is exempted one, you have to put just it is exempted with the reasons. You have to clearly mention the reasons and take the total the taxable dividend, because when you are calculating the taxable income, you have to identify the all the taxable sources. taxable employment income, taxable property income, taxable interest income, taxable dividend income. All in all the exempted things we are just ignore, but you have to clearly mention due to this reason it will be exempted. No need to add to the income tax sources. So that's how you have to find out the what would be the taxable source, the income source. Okay, so that is about the dividend income. Today we have discussed two sources, interest income and the dividend income. So under the interest income we discussed whatever the investment made on that, we receive the interest as a income. So in that case, two income criteria will be there based on the accrual basis. Some of the interest income will be based on the cash basis, especially government treasury bills and the treasury bonds. It is based on the cash basis. You have to identify it clearly, and then when you are based on the prescribed predetermined rates, you are entitled to receive that interest income. That would be the interest income calculation. But when we receive in the interest income, it is subject to the withholding tax. Under the three criteria we have discussed, what would be the withholding tax deductions for the banks and the financial institutions. Different rates are there, individual, charitable institutions, likewise companies and the body of persons. So then based on that, that means the companies, the banks and the financial institutions, they are deducted that amount and we receive the net amount. If it is so, you have to, when you are paying the taxes, you have to gross it up, then determine what would be the total taxable income. And for the debentures, withholding tax would be 10%, and the treasury bills and the treasury bonds, if it is in the primary market only, you are entitled to deduct the withholding tax. If it is in the secondary market, no withholding tax will be deducted because it is the gross amount. So these treasury bills and the treasury bonds are based on the maturity, that is cash basis. You have to keen on that one as well. And we have already discussed some of the exemptions on the interest income. So when you are receiving the questions, sometime it may be the composition of the both the exempted and the taxable interest sources. So you have to identify what would be the taxable interest income and the exempted income and segregated as according to the guidelines. Then find out what would be the total taxable income. Always be focusing on the taxable part, not the exempted one. But when you identify the exempted one, you have to clearly mention the ground rules. And when it comes to the dividend income is based on the equity capital. For the shareholders, if you are purchasing the shares from the company, you will become a shareholder. So at the end of the period, your return would be received as a dividend distribution of the profit. So that it may be in different forms. It may be the money or in terms of shares or other things. So it may be the redemptions at the time of, you have to consider it as a dividend. So we have discussed that one. And then the fixed rate of withholding tax rate would be the 10%. So I have mentioned that in some situations withholding tax will be deducted. In some situations withholding tax would not be deducted. So you have to clearly identify in which situations it will be applied. So according to, you have to identify what would be the gross, whether it is a gross dividend or a net dividend. So then under section 10 there are some of the exemptions on the dividend income as well. So in that case, for these exemptions, dividends, we are not entitled to pay any of the tax. So you can just ignore the paying the taxes on these dividends, but you have to clearly identify why it become exempted. Then finally you have to calculate the total taxable dividend income. So this is about the dividend and the interest income. I will make it available, the detailed note for that one as well. Then I have already uploaded the detailed questions on the employment income because we couldn't calculate the total employment income. Shall we look at on that question, just discuss the how we are going to develop the answer. So in the second week I have make it available under the employment income session, the practice question on employment income. Okay, so it is Mr. Arthur Silva is employed as a managing director of a limited in a public quoted company during the year of assessment 15 and 16. His income from employment was as follows. So that this you are giving the different information, and then finally you are required to compute the profit from employment of Mr. Arthur Silva for year of assessment 2015 and 16. So under the employment income, we discuss different areas: cash benefits, non-cash benefits, value of conveyance granted, payment to third party, and the benefit of the employee, and finally retirement benefits. So that except retirement benefits, all the other adjustments I have incorporated in this question. So we'll do the small adjustments, the discussions on that one. Then I will next week I will upload the answer, detailed answer on that one. So you have to, when you are calculating the profit from employments, you have to identify the mainly cash benefits, non-cash benefits, reimbursement of expenses likewise. So first look at one by one. Just having 10 minutes, try to attempt on the main areas, then after that we'll discuss. Okay, monthly salary would be 2,000, 200,000. So that you have to take the monthly salary, whether it is received or not. On the accrual basis, you have to take the 12 months period, because we have to assume that at the beginning as well. He is employed as a managing director. So in that case, 200,000 into 12 months, you have to take as a gross salary for that particular period. That is 15 and 16, 2.4 million. Then second one, company maintain vehicle with an engine capacity of 200,000, maintain at rupees 420,000 per annum. That means we have discussed that it is under the vehicle benefit, traveling benefit. As a managing director, he has a vehicle. He is provided with a vehicle, cylinder capacity 200,000. So we have identified two different criteria. If it is more than 1500 and below 1500, we have studied different areas with drive and fuel, and without drive and fuel, and with fuel and no drive, and without any fuel and the driver. So these areas you have identified. Per month benefits we have, it has been specifically mentioned. So according to this information, you have to identify which one would be the monthly income. So in that case, it is over and above 1500 cylinder capacity. So in that case, they haven't given that whether it is provided with the drive and the fuel. So you have to just assume that according to this designation as a managing director, he will provided with the drive and the fuel. So that what would be the monthly maximum benefit is 50,000 into 12 months. It will be the benefit, but I have mentioned that if you have received the vehicle with only one vehicle, so that it will be exempted. Even though this 600,000 is a benefit to as an employee of that company, but it will be exempted. You need not to pay the taxes because 50,000 per month, 50,000 will be exempted, as well as if you are having only one vehicle, so that benefit under these two criteria, it will be exempted. So that this 420,000 will not be identified, because these are specifically identified by the Inland Revenue Department law. So in that case, it is exempted. The third one would be the company also bears the cost of maintenance and fuel of another vehicle owned by Mrs. Silva. So in that case, the Mrs. Silva's vehicle he is going to use for the official purpose, but the owner is not the company owned vehicle. So in that case, he is receiving a monthly allowance of 150,000 per month. So that as it is a benefit to even though owner is Mrs. Silva, but Mr. Arthur Silva is going to take that benefit by hiring it to the company. So in that case, it is taxable, because for two vehicles we are not going to provide the exemptions. 150,000 into 12 months, so 1.8 million would be we have to categorize as a employment income on vehicle benefit. And then bonus lump sum paid in April amounted to rupees 480,000. So bonus payments normally we consider as a cash basis, so that once we receive that bonus amount, you are liable to pay the income tax. So in this year of assessment, within the month of April, he has received 480,000 as a bonus lump sum payment. So within that year of assessment, that means 1st April to 31st March 2016, he need to consider it as a employment income. That means he is liable to pay income tax on this 480,000. Then leave encashment entitled in respect of year 2014 was 40,000 and it was paid in June 2015. So leave encashment in respect of not this year of assessment but previous year of assessment. So it is encashed in June 2015. He has received it on June 2015. So that again it is on the cash basis. So once we receive that in cash amount, so you have to pay tax on that particular year of assessment, so that it has received on this year of assessment. This year of assessment means 15 and 16. So that we have to pay 40,000 you have to pay the income tax on this 40,000. That means you have to consider it as a employment income. So this is about the point number 1. Then second one, Mr. Silva is provided a furnished house for which the company pays an annual rent of 600,000 and rates at 80,000. The company has also provided 2 security guards at a cost 30,000 per month. So this is relating to the housing benefit, because as an employee, company providing a furnished house with fully equipment. So in that case, for the Mr. Silva, we have to calculate what would be the housing benefit. In this case, 2 components are there. If it is without furniture, what would be the income and the furnishing income? All together you have to calculate the total housing benefit. Okay, and how we are going to calculate the housing benefit without furniture? So we have used the small equation. First you have to take the gross rent paid by the company. Then you have to compare it with the rating assessment plus rates, whichever is higher, and also it is subject to the 180,000 based on his gross remuneration. Okay, in this case, company pays annual rent 600,000. That means the gross rent paid by the company is 600,000. And you have to compare it with the rating assessment plus rates. In this question, they haven't given the rating assessments or even the percentage rate. So in that case, so you have to just assume that the rating assessment plus rates, that is rental value, is less than the gross rent paid by the company, because we don't have the enough information to calculate the rating assessment plus rates. Only we are having the 80,000 absolute figure. So if you received at least a rate okay, start with the point number 2. So in this case, Mr. Silva provided with the furnished house. So in that case, we have to identify the housing benefit. It is under the housing benefit, house provided by the employer. So in this case, he has provided a furnished house. So you have to calculate what would be the furnishing benefit separately and the empty house. So in that case, for the calculation of the empty house benefit, you have to take the gross rent received gross rent paid by the company. In that case, it has mentioned that the annual rent payment would be 600,000. Then you have to compare it with the rating assessment plus rates. In this case, you are not given the rating assessment, just having the absolute figure of rate, so that you have to, in that case, you had provide the assumption that rating assessment plus rate is less than the gross rent paid by the company, because it is lack of information. So for the examination purpose, we are going to accept that one. So here we assume that the rating assessment plus rate is less than 600,000. So in that case, when you are comparing with that one, again the gross rent would be the highest amount, that is 600,000. Then you are going to again compare it with the maximum limit. How we are going to decide the maximum limit? The maximum limit is based on the gross remuneration of that particular employee. So that gross remuneration for this Mr. Arthur Silva is, his monthly salary would be 200,000. The gross remuneration means the regular benefits you have to calculate. So when you are calculating the regular benefits, out of these his salary, the whatever the remuneration payments, so we have to take the monthly salary, it is 200,000. So company is vehicle is exempted, so you are not going to take it as a monthly the regular benefit. But for the second vehicle, it is a regular one, because 150,000 per month you are receiving, so that 150,000 into 12 months. So you have to take the bonus as well, and the sorry. Bonus and the leave encashments are not regular basis, so that you have to just ignore those things. Then you, so you can take only the monthly salary into 12 months and the traveling allowance into 12 months. Those are the regular benefits. So it is regular benefit is I think it is around 4.2 million. Yes, around 4.2 million. So that you are going to compare his gross remuneration with the specified ceiling, whether it is greater than 101.8 million or less than 1.8 million. So in that case, it is greater than that. So that the housing benefit is limited to 180,000. So for the empty house, the benefit is 180,000. Then you have to add the housing, the furnishing benefit to that empty house. To calculate the housing benefit. Again, it has a small equation, if you can remember, 2.5% on the gross remuneration, and then you have to compare with 1,500 per month. So whichever is lower would be the furnishing benefit. So that 2.5% of the gross remuneration means the regular benefits. So his regular benefit would be, annual one would be 4.2 million. So it is around, it is 105,000 around. So the monthly one would be 1,500 into 12 months. So that 18,000 would be the maximum limit. So out of that you have to select the minimum one. So that means the furnishing benefit would be 18,000 plus empty house 180,000. So the total housing benefit is limited to 198,000. So that is about the housing benefit. Apart from that, it has mentioned that the company has also provided 2 security guards at a cost of 30,000. So it is again the company is going to bear the cost. So but it is not relating to this housing benefit, but for the security purpose they are providing these 2 security guards. Again, due to his employment, he received that benefit. So you have to add that benefit to your employment income. So 30,000 into 12 months for the security guards. So it is again employment income. So under the point number 2, you are having two income sources under the housing benefit, 198,000, and the the non-cash benefit. Under the non-cash benefit, two security guards cost 30,000 into 12 months. It is another income. Then third one, during year of assessment 15 and 16, Mr. Silva was entitled to employee share ownership scheme. He exercised the option and purchased the shares in the same year at a cost 60 rupees per share, when the market price of the share is 75. Under the scheme, Mr. Silva owned 10,000 shares. I have mentioned that under the employment income, employees can purchase the shares of the company under the share ownership plan. So in that case, the company is going to issue that shares, the price where it is less than the market price. So sometime it is total free of charge. So in that case, you have to identify what would be the benefit as an employee. So if it is not an employee, he has to purchase at the market price. But since he is an employee of the company, he is receiving that shares at a lesser price than the market price. So here Mr. Arthur Silva as well, he has obtained that benefit because market price is 75, but he has purchased it at a 60 rupees. So that the benefit is 75 minus 60, 15 rupees into 10,000 shares, total 150,000. He has a benefit on the share purchase. So again it is this 150,000 is employment income. And the fourth one, during the year, Mr. Silva was reimbursed the following expenses. He has reimbursed the following expenses. So you have to identify whether this reimbursement of expense is employment income or not. The employment income means if it is a private expense, you have incurred that expense for your private or the domestic purpose, but company reimburse that one, it will not become an expense for you because it is due to the reimbursement, it will become an income to you. But if we have incurred that expense for your office work due to your designation and the responsibilities, so that even though it is reimbursed, it is for the official purpose, you are not entitled to pay any income tax on that reimbursement, even though it is a reimbursement, but it is due to the official matters. So if you are receiving the reimbursement of expense, so you have to clearly identify whether it is a private expense reimbursement or official expense reimbursement. If it is official expense reimbursement, it is not an income. If it is official private expense reimbursement, it become a income to the employee. So first one is entertainment, friends and relatives at home, 45,000. He has a party with his friends and the relatives at home, so that he has incurred 45,000, but the company has reimbursed that one. So it is purely a private or the domestic, so that he has to, when you are calculating the income, this reimbursement of expense would become an income to the company because it is a private expense, but company has reimbursed, so that it become not an expense but become an income to him. So you have to pay the taxes on this 45,000. Then entertainment, customers at home. In that case, sometime it may be some debating points, but as a managing director, based on his designation, we can assume that because the customers are the key factor for the company, so he has made some entertainment to the customers at home, but it is still not a private or the domestic purpose, but to have a close rapport with the customer. So he has done that entertainment at his home. So in that angle, it become official, because to entertain the customers is not a private one, but due to the company factors, it will become an official one. So if not, just customers at home, some may be identified it is just a private expense. So based on that two assumption, if it is official one, so even though it is a reimbursement, it will not be a income to the Mr. Arthur. So due to the official matters. Then entertainment office staff at home during Christmas. Okay, again office staff, the Christmas party they have given at in his home, so that it is again normally we consider it as a welfare functions. So at the welfare functions for the staff. So in that question, in that point as well, it may become official activity, or some may identify it as a private one. So, but you have to provide the justifications why it become a private or the official one. If it is official one, for the time being, I am going to take it as because as a managing director, he is going to provide this entertainment to during the Christmas season for the office staff is just is an right to do that factors to the office staff as a managing director. So in that angle, it become an official factor. If so, this reimbursement of 60,000 will not be subject to the income tax. So because it is a official thing. Then taxi fares for traveling from home to office. So again, the taxi fare for the traveling, it is home to office, that is we classify it as a private expense, not the official one. So 25,000 reimbursement, you have to consider it as an income, not the official factor. But the next one is taxi fare for travel from office to bank. He has traveled to office to bank, so that some of the official matters may be, so that in that that reimbursement 50,000 is a official. Sometimes there may be some discussions with the bank officials, so that he may have to claim that as a official traveling. So that 15,000 will not become a income to the Mr. Arthur because it is a official traveling. Then last one would be mobile phone bill. When you are reimbursing the mobile phone bill, even though they have reimbursed the mobile phone bill, you are going to consider it as a 50% on the reimbursement, so that reimbursement of the mobile phone bill you have to take out of 240,000 only 50,000, 120,000 would be the income to the Mr. Arthur Silva. So those are the reimbursement of expense. So like in this case, sometime there will be some debatable reimbursement of expense, but if you can justify why it become a private or the official one, so anyhow you can score mark, but the strong justification should be there. And especially the mobile phone bill, even though it become a reimbursement, because sometime mobile phones cannot identify whether it is private usage or the official usage. That's why it become 50%. We are going to add as a employment income. So when you are coming to the reimbursement of expense, in whatever the situation, you have to identify whether it is a private one or official one. It become a private expense, you have reimbursed, it should definitely become an income to the employee. And if it is reimbursement of expense of official factors, then it will not become an employment income. So that would be the reimbursement of expense. Next one. During the year, Mr. Silva has traveled to India in December 2015 to meet certain customers of the company. Company has paid for the expense in respect of traveling. Airfare allows for the accommodation. So again, it become a traveling outside Sri Lanka. So this traveling is not relating to his personal factors. Again, you have to check whether that traveling is for the official one or not. For in this case, it has clearly mentioned that in order to meet the customers, he has traveled to India, so that this reimbursement expenses will not be the employment income, because the traveling is done for the company official activity. So this 50,000 and 70,000 will not become the employment income. Then during the year 2015 and 16, Mr. Silva underwent an operation. The cost of the operation amount 250,000 was met by the company medical insurance scheme. The premium paid in respect of this policy was added back to his income from employment in those years. So this is relating to the medical benefit. When I study the medical benefit, I have mentioned that 3 different medical benefits are there. If there is a block contribution made by the company, and if you can identify the premium paid by the company to each and every individual, and the third one would be the just reimbursement. So in these 3 situations, the medical benefit will be determined for the employee in 3 different ways. For in this case, for the Mr. Arthur Silva, they are going to identify the separate one, because specifically they can identify the premium contribution, because the last sentence mentioned that the premium paid in respect of this policy was added back to his income from employment in those years. That means when they are paying the insurance premium, they are going to identify for the Mr. Arthur Silva, this would be the insurance premium amount, so that if we can specifically identify according to the guideline, so in that particular year of assessment, when the premium contribution is going to allocate, so these things should have to be added to the employment income. So that in this case, at the reimbursement, he is not liable to pay income tax. So in this case, the actual expense is 250,000. So for this 250,000 will not be an employment income to Mr. Arthur Silva for the year of assessment 15 and 16, because the his premium is specifically identified in each and every year of assessment and add back to that the premium to his employment income. But just assume that the block contribution is made without in that case we cannot identify what would be the premium paid to the specifically to the Mr. Silva. In that case, as a bulk we are going to pay to the insurance company. If so, this 250,000 would be the medical benefit reimbursed to the Mr. Silva for the 2015 and 16. So if so that you have to put the 250,000 would become the employment income under the medical benefit. But in this case, that is not the case, because we can identify specifically the premium paid to Mr. Silva. So in that case, at the time of we are paying the premium, we are going to consider as employment, not at the point of reimbursement, so that this 250,000 will not be classified as a employment income. Okay, those are the things I have incorporated for this particular question. So That's how you have to identify whether it become employment income or not. Then next week I will upload the answer for this detailed answer with the justifications to the LMS page, so you can refer. And if there is any queries and clarifications, you can raise. If not, we can wind up. Okay, thank you very much. The next week we are going to start the business income by Mr. Rangalla, and the assignment is due December 3rd week, so you have to keep on touch on that assignment submissions as well.